Thank you very much, and thank you for your warm welcome. Certainly the comments I'm about to make will certainly be putting up on our To Your Credit website, just to give that a plug, which is our task group website, which you can find on the church internet site. But I'm sure it will be publicised more generally as well through the conference process, but it certainly will be up on the To Your Credit website, which if you haven't had a look at, I'd encourage you to do at some point. So I think the plan is I was going to speak for about 25, 30 minutes or so, which would give some time for questions at the end, which I think Paul is going to chair. And in a way, sometimes I always think questions are more useful than sort of set addresses, because it enables people to talk about the things that actually matter to them, to us. So I encourage you to use that time. But I have got a few comments. I was asked to explain why the financial crisis happened, explain what we're doing about it, and tell you what the church could do to solve it. So it was pretty simple, really, in half an hour. I made a bit of an effort here to do that. I should hastily say that this is essentially, particularly where we've got opinions, personal opinions by myself, rather than by any of the organisations that I work with or for. So with that little bit of disclaimer in advance, here are my thoughts. So, most financiers are optimists. Most financiers are primarily motivated by personal reward. Some financiers are willing to do wrong to gain personal reward. The system is too complex to fully understand. Unintended consequences happen. So, if you combine those statements, opinions, with the ambition of politicians, the parochialism of regulators, the imperfection of economic science, and the lack of knowledge and materialism of consumers, you've got a pretty good shorthand description of the fundamental drivers of the financial crisis. That's broadly why it happened. So, and I might just remind you that it was the worst in modern times, and it has inflicted considerable damage on the global economy, and of course, more importantly, seriously, adversely impacted the lives of many. So, the question I thought I would talk about today is, has society responded in the best possible way to that crisis? And what role can the church and the church community play in that response? So I'll try to avoid giving a sort of academic economics lecture here, but I think to respond to the first question, it is constructive to differentiate the elements of the crisis. There are those which arose from poor financial risk management, which is sort of technically known as prudential risk, and those elements which arose from behavioural failings and mis-selling, which is otherwise known as conduct risk. And I think when you look at the response to the prudential elements of the crisis by the authorities, that has actually been pretty comprehensive. The essence of the measures can be summarised under three headings, I think, broadly speaking. So firstly, the authorities have drawn up improved rules, and the principal prudential rules are those that govern the minimum amount of capital and liquidity that a bank should hold. I personally see those rules as defining the boundaries, if you will, within which the bank's management take responsibility for their own decisions and the consequences of those decisions. Good regulation should ensure that the consequences of bad decisions are primarily restricted to impacting capital providers, the people who provide the capital to the bank, and employees, and not taxpayers, not society as a whole. And I think the new prudential rules have undoubtedly significantly reduced the probability of a bank failing, and thus putting the wider society at risk. Secondly, the authorities have strengthened their deterrence capability. So in the UK in particular, they have introduced rules to make senior executives accountable for reckless decisions, which should have the effect of focusing their mind when making risk decisions. And finally, the authorities are working hard to ensure that when a bank fails, it does not impact adversely the wider economy. I think there's still more work to be done in this respect in regard to the very large global institutions. However, I do believe it's reasonable to assume that it's unlikely in the future that the taxpayer will be required to act as a backstop, at least here in the UK. So overall, it seems to me this is a pretty strong and thoughtful response to the prudential elements of the crisis. It recognises that failures and mistakes will happen, but reduces the probability of their occurrence and their impact. In respect of conduct issues, however, I think you can make a case that the response has been less comprehensive. The regulatory response has so far primarily focused on pursuing retribution on firms or individuals who either missold, in the case of, for example, PPI, or indeed acted improperly, such as in the case of the LIBOR fixing. Consumers have been compensated where relevant there, and in addition there have been some changes to the regulatory regime, and firms have significantly enhanced their own compliance and oversight structures. Nevertheless, and this is the key point here, overall, in my view, there is still much work to be done to make the system fairer and more ethical. So, the rest of the time this morning, I'll consider the question of how the Church can assist in developing a more ethical financial system. But before doing that, I think it's worth just briefly addressing why should the Church be involved at all. I believe this is a mission of the utmost importance. It's clear, as the earlier speakers have already illustrated, that financial distress is one of the principal causes of social detriment. Indeed, the Archbishop has emphasised that helping alleviate financial distress should be central to the Church's mission. This call to help people manage their money should be a key part of the Church's mission. It reflects the belief that how we handle money as individuals and communities is central to living full and contented lives in all its fullness. A further few statistics to remind us why. Some of you have already heard some already, but there are 8 million adults who are over-indebted in this country. The average amount of unsecured debt in the UK, excluding mortgages, is around 6,000 per household. And as has already been indicated, there are some 21 million who don't have £500 in savings, and therefore, if a shock came into their lives which required some unplanned for expenditure, they would not be able to do anything about it and would find themselves in difficulty. So those statistics alone, I think, justify action. But it's clear that, of course, financial distress creates even greater distress for many at the personal level. And again, there are a variety of statistics you can use to illustrate that. The ones always strike me very powerfully are some from Christians Against Poverty, who give out some statistics on their clients, pointing out that of the clients that contact them, 65% will then have visited a GP for reasons arising from their financial distress. Something of the order of 34% will have contemplated or indeed attempted suicide, and somewhere around 21% would say that their family relationships had broken down entirely as a result of their financial difficulties. And these statistics, I think, in a way, are the more powerful in the sense that they absolutely illustrate the point that financial distress leads to personal distress. And that, in my view, is why the Church should be involved, and should be involved with passion and commitment. So if you agree with that, if you agree the Church should be contributing to a fair and ethical financial system, it's maybe useful to consider briefly what would an ethical system look like. Well, I think, in my opinion, an ethical financial system would be fair to all users, fair to providers and users. It would be accessible to all, and it would serve the common good, and in particular provide responsible credit. So against those criteria, is the current system ethical? Well, I would say clearly not. It's not at present fair to all. In my view, that's obviously demonstrated by the fact that many of the current conduct scandals have occurred within the last couple of years. It's clearly not accessible to all, as demonstrated by the fact that some 1.5 million adults are without a bank account. And crucially, many would assert that the common good is not well served. A good example of this being the relative scarcity of responsible credit. In that context for a moment, what do I mean by responsible credit? Well, in my view, responsible credit would have the following features. It would be realistic, i.e. offered with the reasonable expectation that the borrower can meet the terms of the contract. It would be affordable, i.e. the interest and charges are fair. And it would be flexible, i.e. the repayment terms are flexible to allow for unforeseen changes in people's circumstance. Another way of expressing this is that the contract should be in the long-term interest of both the lender and the borrower. Clearly, if you apply these criteria against many high-cost credit providers, what they're doing is unethical. So, it's relatively straightforward, I think, to assert that the system is not as ethical as we would like. The more difficult question is, how can we improve it? Recognizing in particular we have to work with human nature and accept our limitations. So I do think the system will never be perfect, but it definitely can be a lot better. So, how do I think we could make it a lot better? Well, I would suggest we should see changes in 4 areas. Firstly, firms and regulators need to strengthen the oversight and deterrence framework in relation to the conduct of institutions. In my view, the regulatory rules have a role to play. For example, they've undoubtedly been the main driver in reducing high-cost short-term credit issues. However, the main focus for oversight should be the compliance and audit functions of the firms themselves. These have been significantly strengthened, but there is, in my view, a lot more that firms could do. And in particular, they could work on significantly improving their cultures. Enforcement and deterrence are the responsibility of both regulators and firms. Again, good progress has been made here in demonstrating that willful wrongdoing will be punished, but in my opinion, further resources are still needed in this area, in particular in relation to criminal prosecutions. Secondly, firms need to increase the alignment between serving the common good and the actions of their institutions and their employees. Here, the focus needs to be on firms creating and sustaining the right cultures and the right incentive systems for their employees. Thirdly, society as a whole needs to increase the financial capability of individuals, and in particular their ability to manage when they find themselves in financial distress. And you heard earlier that a new financial capability strategy for the UK has just been launched. I was involved in the board that prepared that paper, and I very much hope that all relevant organisations in that space unite to take forward the recommendations in that document. And finally, competition and diversity in the system need to be increased. In particular, in my view, and this is something I feel very strongly about, the community finance sector needs to be strengthened. Why do we need a stronger community finance sector? Well, I would suggest there are 2 principal reasons. First of all, they are local. Community finance organisations have the local knowledge and commitment that is vital to delivering services to the disadvantaged and credit to start-up businesses and local enterprises. And secondly, they are cooperatives. They are member-owned and thus, from the customer perspective, provide the benefits of mutuality. I would note, I won't go into it here because it would take too long, but it is worth noting that, of course, mutuality does have some structural drawbacks, and I'm not suggesting that all financial institutions should be mutuals, but I am suggesting that the system would be a lot better for a much bigger mutual sector. So, given this analysis, what does that mean for the church community? I think the principal area where local churches can respond is through helping create a vibrant and sustainable community finance sector, and through help assisting people to manage their money well. And that essentially has been the mandate of the Archbishop's Task Group, which, as you've heard, I've had the honour of chairing for the last 2 years or so. So the rest of my talk is focused on the task group's wider agenda, but I would just like to note that, of course, the task group arose out of the Archbishop's comments on Wonga, I think now known as the War on Wonga. And I should just point out there that the comments were indeed a catalyst for significant changes in the landscape of the credit sector. We do now have tighter regulation and a price cap on short-term credit, and that has resulted in a decline in payday lending of some 68% from its peak in 2013. And also in support of that proposition that we have seen a significant decline in unethical lending, Citizens Advice have reported a 53% drop in the number of payday loan problems that they are seeing. That's between April-June 2015 compared to the same period last year. So I do think his words did have significant impact in that space. But I'd like to talk further about the wider task group mandate. And the wider mandate was to promote responsible credit and savings, reducing dependency on payday lending and other forms of high-cost credit, and supporting the development of larger and stronger community finance institutions. It did also have a subsidiary objective of reinforcing the Church's place at the centre of local communities. So how did we go about delivering this mandate? Well, just to emphasise, we've not been seeking to solve the whole problem, but rather to identify a set of practical and achievable actions through which the church community can make a difference by harnessing the national and grassroots resources of the church. We grouped our actions into 4 work streams: education, church community support, direct service provision, and influencing. And in all cases, we were not seeking to reinvent the wheel, and we're very much aware of the importance of building on existing work, of which there is much within the church already. I'm sure many of you here are engaged in it. And we are conscious that initiatives will only succeed with the support and enthusiasm of church communities at the parish level. So let me just briefly comment on each of the work streams. Education. Helping society manage money from a more informal perspective is a multi-generational project. So equipping children is a key element of the mission. The task group concluded that the church's focus in this area should be on primary schools. This reflects the fact that it is both the most neglected area with regard to financial education and the area where the church has the most influence. You may know this, I did not when I started this project, and I was astounded by the statistic that 1 in 4 primary schools are Church of England schools. So there really is an opportunity here for the church to make a difference, particularly since only around 1/3 of all primary schools are actually offering any form of financial education. So the vision for the programme here, termed Lifesavers, is to establish an effective national financial education programme for primary schools, with the intention of equipping children with the knowledge, skills, attitude and values to manage money well, both now and in the future. It's a joint initiative with Young Enterprise PFEG, and it consists of 3 interconnected components. Establishing a weekly savings club for children in every school. That would be administered by the local credit union and run by the students, under, of course, supervision of adult volunteers. Provision of training and classroom resources to help teachers to integrate financial education within the whole school curriculum. And this includes a strong values component based around 4 core Christian values: generosity, thankfulness, justice and wisdom. Then finally, it's very much a whole community approach which actively involves parents, staff and church volunteers, creating opportunities for the wider community to contribute to financial education provision within the school and helping to reinforce positive messages around money to the whole community. So this approach builds on a number of successful small-scale initiatives in various parts of the country. as well as evidence of what makes for an effective financial education program, starting early, giving children a practical experience of handling money, and ensuring that children receive consistent messages from a range of sources. So the Life Savers programme is currently being piloted in 3 areas: Bradford, Nottinghamshire and South East London, and we plan to roll that out to 120 schools from early 2016, which would benefit an estimated 30,000 children. Turning now to community support. So the Church of England, of course, is the best branch network in the country. A major high street bank has at most 3,000 branches, but the Church of England has 16,000 churches. So it makes sense to harness the energy and enthusiasm of this network. And to do that, we've created the concept of church credit champions. The network was launched in May 2014 with pilots in London and Liverpool and plans for a wider rollout. So far, the pilot has engaged over 200 churches, trained 150 volunteers, and is on target to bring in 3,000 new credit union members. The vision, however, is for a countrywide network of clergy and lay people who are trained and supported as credit champions. Over 50 credit champions from the pilot diocese were recently commissioned by the Archbishop of Canterbury, and we hope that in time every diocese will have enough of these trained volunteers and clergy to deliver help to everyone who seek it. So the core mission of these credit champions is to support local community finance organisations such as credit unions, and that specifically includes raising awareness and encouraging active membership by the church members in their communities. Secondly, it's to ensure that those in financial distress have access to quality debt advice. So this would obviously require training of the clergy and lay members as debt signposters to their local community, using the debt awareness and signposting training which has been developed by the Money Advice Trust. Thirdly, they would work with the Life Savers programme I've just described. Fourthly, they would more generally provide information and help for those who wish to save and borrow through ethical organisations. And finally, encourage the use of church premises for the delivery of community finance and more generally in support of the initiatives I've described. The pilot programme is expected to generate some 2.2 million in social value in terms of increased access to more affordable credit, and that's nearly £7 for every £1 invested in the programme. The next stage is for an 18-month rollout to 30 dioceses, which would train 6,000 credit champions and would benefit 2.5 million people. The third area is direct service provision. Now, this is an area we looked at. Modern technology has opened up many ways of accessing credit for both small businesses and individuals, mainly through peer-to-peer lending. The task group did look at the question as whether somehow or other this new area could be utilised by church congregations for the benefit of the communities they live and work in. After a lot of thought, I think we concluded that for the church to actually endorse or operate a specific platform was probably inappropriate. But we did conclude it was important for the church to support and raise awareness of these alternative non-bank finance mechanisms, which do indeed help, I think, fill the funding gap for small businesses in particular, and definitely contribute to a more competitive and diverse and therefore hopefully fairer financial system. So it wasn't directly part of the task group's work. I'd also at this point like to draw attention to the fact that during the period the church has launched its own credit union for its own employees, the Church's Mutual Credit Union, which is up and running and I'm sure will be a very successful organisation. Finally, the task group has been involved in the influencing agenda, by which I mean helping and adding value to the many existing initiatives designed to promote the growth and development of community finance. And maybe just at this point, I might slightly diverge to make an important point here, which is that the task group is fully aware that currently many credit unions are not equipped to the degree necessary to fully engage with our initiative. Success, therefore, will require not only the commitment of the church community, but also the commitment of many credit unions to further enhance their services and credibility. And central to achieving this is the success of the project financed by government to provide a technology platform. And I do strongly support this initiative, and it's vitally important that it's successfully completed. The task group has also been engaging with regulators, public policy makers, to seek to ensure we've got the right balance between encouraging growth and new entrants into the community finance sector. In my view, there is a risk that, particularly with regard to prudential regulations, that the regulations are too concerned with consumer protection and are not focused sufficiently on the benefits to society of growing the sector and encouraging new entrants. In summary, the two principal initiatives coming out of the task group are the Church Credit Champions Network and the Lifesavers Programme. And as the 2-year lifespan of the task group draws to a close, we do indeed, you'll be pleased to have a plan to ensure that these initiatives continue to be supported. We'll be creating a foundation termed To Your Credit, which is also the name of our website, and that will then be an umbrella organisation to oversee the Church of England's continuing work in promoting responsible credit and savings, and will work with, in particular, the Church Urban Fund and Young Enterprise to deliver the programmes. But longer term, I think, even if we've got new structures, these initiatives will only succeed if they become embedded in the church community as a core part of its mission. And this does require ownership by everyone. It's only going to come about through the collective recognition that managing money well is key to living a fulfilled and contented life, and it is the duty of Christians to help people achieve this goal. So hopefully that gives you a flavour of what the task group has been up to, and gives you a flavour of the possibilities that I believe it has opened up for the future. As I mentioned before, there's a lot more information on our website. But for me, in a way, the most important statistic I've heard recently in relation to the task group's task is the fact that 31 out of 40 dioceses and over 2,000 Anglican parishes have now got actively involved in supporting credit unions in various different ways. That is a fantastic start, but certainly I, for one, am not going to be satisfied until every church is involved to the degree that it can be in this initiative. I do believe that that vision is achievable. It will take hard work by everybody, but I believe it is achievable. And I believe it would be extremely worthwhile. So, as I say, hopefully those thoughts have stimulated some questions and some discussion, and I'll be happy to take questions. And thank you very much for your time this morning.
Hello. Right, well, thank you, Sir Hector. Are there any questions? Now, I'll tell you what we'll do. Before we have any questions, we'll just have a minute talking to the other people on our table about what we've heard. So just 1 or 2 minutes just talking to your neighbour. There's a question here.
Hello, my name's David Lucas from Disability in Jesus. In the disabled world, many people have been managing on very meagre amounts of money already. The emphasis of your work seems to talk a lot about educating people how to manage their money. The meagre amount that they've had is now being cut. To offer to educate someone who's been managing on a meagre amount already seems to me dangerous. You're likely to get told what to do with your advice. Have you got an answer for that, really?
Thank you. Patrick? You are. It's coming. No, I think it'd be better to stick with it if you could.
My question is, you said, Sir Hector, that there had been a 68% drop, I think, in the number of people wanting payday loans since the Archbishop spoke. My question is, what have those people been doing instead?
Okay, any other questions? There's a question over here.
Hello, my name is Eric Thompson from Freedom Community Project, but I manage a credit union as my day job. Can I ask Sir Hector how he feels the government should play in this arena, because there's been no mention of that, and in many ways their policies are potentially creating some of the issues, as my colleague over there on disabilities is suggesting, and at the same time their practical help for the sector that we're describing is diminishing.
Right, I take those three. So, I mean, there are many more. Hopefully we've got time to have a few more. To the first three. So you're entirely right in saying that this initiative, and indeed financial capability, is not in itself about tackling poverty. I mean, clearly there is a level of income on which somebody is always going to struggle to survive, or maybe even can't survive in a way that society would think acceptable, regardless of how well they manage money. That is a different problem. It is a linked problem, but it is a different problem. But I think the point of financial capability is to say that there is a vast swathe of the population, probably many, who, if they did manage their money better, would be able to avoid subsequently falling into debt, and then with all the subsequent social distress that comes with it. So there's no suggestion that financial capability is about addressing poverty. What financial capability is about is ensuring that whatever resources you do have, you manage well, and therefore through managing it well, avoid, for some people actually do manage to avoid falling into financial distress. And there's plenty of evidence to that effect. And in particular, the point I would really make, and this is a step change point, but is this issue of a little bit of saving. If you sit and I have sat in the call centres with step change, listening to people going through budgeting, which includes people on benefits, and it is possible for many, I'm not saying for everybody, it is possible to save a little bit. And if you save a little bit over a period of years, you create that buffer of £500 or £1,000, and that will transform your life. Because when your stove fails or you have some unexpected utility bill, if you don't have to go into debt and you can dip into that buffer, that will avoid a slippery slope in the wrong direction. So I entirely take your point that this is not solving the problem that you're talking about, but it is a meaningful and significant problem which can be significantly helped through the actions I'm describing. To the other two questions, so to the question of the payday lending volumes, I mean, there was a lot of noise mainly made by the trade associations of the payday lenders, that if they disappeared, what would happen is everybody would go into the unregulated sector of the loan sharks, and that actually detriment would be greater. And there was some statistics vaguely kind of produced out of the US to try to support that argument. As far as we can tell, that hasn't happened in the UK. So broadly speaking, when you look at what was the driver of people going to high-cost credit providers, and it is a bit of obviously you can debate on the margin what is necessary credit and what is not necessary. I understand that's a judgment call. But loosely speaking, you'd probably say about half of the demand for high-cost credit was for understandable reasons, that people really do need that credit. The other half was more for impulse buying, and where you could argue that they just shouldn't have been making those purchases. And so that half, which was for understandable reasons, does clearly need to be there. We do need to have credit that people can access for those reasons, and that's where the credit unions and others need to provide more capacity. But there seems to be reasonable evidence that extra capacity has come on stream. So I think it is obviously an anxiety that you end up just pushing people into worse sources of credit than even the high-cost credit providers. But there isn't any evidence of that happening so far in the UK. So it does seem to have worked out pretty well so far. To the third point about government and credit unions, I mean, it is the case at the moment that credit unions are only about 2 or 3% of the finance sector in the UK, which is very, very small. And there's plenty of evidence that in other economies, Canada, Australia, the US, etc., that traditionally the mutual sector is more like 20 to 25%, And that seems to produce a much more balanced, fairer, more ethical system, more resilient system as well, and provides more credit into the local communities, particularly for startup businesses and so on. So, it would be a lot better, in my view, if the UK had a mutual sector of more that sort of size, 20 to 25%. Why isn't it that sort of size? Well, it's partly to do with the way the credit unions were structured here. They tend to be more geographical rather than employee-based. And in the US in particular, payroll deduction has helped employee-based mutuals grow very successfully. I mean, the Armed Forces is one of the top 50 financial institutions in the US, in fact, Armed Forces Credit Union. So I think government encouragement to encourage payroll deduction would be extremely helpful. I think the other reason why the sector has been stronger in other countries is they have had more mutual pooling of central resources, which is why the government-funded credit union expansion plan is critical, which is helping the credit unions invest in mutual infrastructure, which they can all use. So that needs to be completed, as I've said. But I think the government could continue to do more in other areas. One possibility, which is personally I think it's a good idea, so I know there are a range of views on this, is potentially set up some form of community finance foundation which would lend money to help capital be built at not-for-profit rates, which I think would also be helpful. So I think there is more that could be done centrally, both through regulatory intervention and through support. It is very difficult for credit unions to grow because they are mutuals, and therefore, in general, where sectors have developed, it is because there has been help from public policy, and I certainly encourage that intervention. And I think it would be more helpful than we've seen. We could do more than we've seen so far.
Thank you. Any other questions?
Hi. There is an assumption that...
Just tell us where you're from and who you are.
Sorry, I'm Val from Durham Diocese. There is an assumption that credit unions all want to work with churches, and as they're expanding and being encouraged to expand, we're finding, A, that there's a lot of competition, so they're not working well together, and also we're beginning to question whether they really want to be embedded in our churches and our communities.
Question here.
Kevin Peacock from St Andrews in Liverpool. My question is very similar to the previous question, actually, and it was just picking up the point around the community finance sector being both local and member-led. And I think as credit unions grow and have to expand their depositor base, there's less incentive for them to retain that kind of local feel. So the kind of transaction over the counter, the relationship with individuals on the ground, and in some way that kind of localised service delivery, we're seeing we're losing that at a local level as the credit union expands its common bond. So I welcome the drive to diversify and grow the community finance sector, but remaining small, I think, is an integral part of that. What make that community finance sector special in the first place.
We'll have a Jim question.
Just
tell us who you are, Jim.
Sorry, Jim Roberts, and I live up the northeast of England. I wonder whether managing money well includes the church having a role in how people manage equity. And to turn Paul's earlier comments that in terms of supply and demand, there was obviously plenty of supply just before the election when people my age managed to invest £13 billion in so-called granny bonds, so plenty of supply of money. And how do people live with that equity? What is the role for the churches? And if I could connect it to the decision taken last week north of the border in relation to Trident, and the trade union man said it was indulgent not to make arms, and how that connects with a kind of theology in relation to, obviously talking about people's jobs and the arms trade, but indulgent. We must keep making money off that side. Where does this connect to that?
Right.
Let's do it. Let's just do one more question to balance it up a little bit. Just that lady there.
Thank you. Karen Davis from an ethical lender in South Wales. I've heard you mention a lot in connection with community finance about credit unions, but there are others like me in the sector, the Community Development Finance Association. Were they included? I just wanted to check.
Yeah. Right. So to the opening point, I mean, I think this is a very important point, and I did make reference to it in my remarks. I entirely agree with you and have heard many people make the observation you've made. So we shouldn't think that every credit union out there is just sort of desperate to work with the church, and with, you know, the moment you knock on their door, they're going to be welcoming you with open arms and embracing all the goals and objectives I've talked about and others have talked about. There's undoubtedly the case that many credit unions are just comfortable in their own little space. They were set up for their own members' purposes, and they're not particularly wanting to sort of step outside that comfort zone. That doesn't make them, you know, I mean, they're still worthwhile institutions for their members, but they're, you know, happy in their space and not maybe wanting to branch out. And indeed also there's quite a few inefficiencies in the credit union sector, as I've mentioned. And also they have quite a high failure rate. I mean, something in the order of 8 to 10 credit unions fail a year out of 300. Of course, just to remind you, your deposits up to the $75,000 are guaranteed through the FSCS scheme, so you're not putting people's money at risk by encouraging them to make deposits. But that failure rate is quite high and does demonstrate that there's quite a few inefficient organisations out there. So the credit union sector, as is, currently has a significant limitation. So I think the presumption sitting behind this initiative is that it is not really it's not really that the church goes out, knocks on the door, and the credit union is there waiting, ready, raring to go. It is saying that part of what this objective is the church community works with the credit unions to help them develop, help them reach out and do more, help them grow, help them equip themselves better. So there is one of the underlying premises here is that what we're actually trying to do is help the credit unions grow, and that without help they're not going to grow. And it also means that not every credit union is going to want to go in that direction. So there are, you know, there will be some who won't. So there's definitely, you know, some limitations in that respect. And that maybe takes us to the last question, which is we did very carefully reframe this proposition to community finance as a whole, which it does include CDFIs, but they are a very, very small percent of the market at the moment. So in that sense, they're not that significant. And it does also include any form of mutuality and could include building societies and so forth. So we are making a wider point that we want the church to help develop the totality of the spectrum of community finance. But you're absolutely right, not every credit union is going to want to cooperate and share the same vision, and you have to seek out and find the ones who do and work with them. To the point about sort of size and impact, clearly one of the benefits of credit unions and of community finance organisations is that local knowledge. Clearly there's a point in the size spectrum when it will become more difficult for them to have that local connection. There may be one or two credit unions who are beginning to get into that sort of space, but personally I would argue we're a long, long way away from that. I would describe that as a high-class problem. If we ever get there, I think we've got a long, long way to go. I think there's lots of evidence, certainly. I don't know the credit unions here in Manchester, so I'm not going to comment. But certainly down in London, for example, where there's one I'm a member of, as you'd expect. I've joined one relatively recently, I'll be the first to say. But these are quite big credit unions, and they do seem to still be able to have that local engagement, local knowledge, and local connection. Even so, they are pretty large, and most credit unions have got a long way to go to get to that sort of size of institutions. I certainly know some of the ones in Glasgow, which are some of the biggest in the country, and I have indeed visited the ones in Edinburgh of a similar sort of size, and they do still seem to have the local connection. So I agree in the long term that's a problem, but I would suggest we're a long way off that.
I think we're going to have to call it to an end there, because we should have finished the session at 11:30. So Hector's going to be here over lunch, so I'm sure he'll be...
I'm here till just about 1 o'clock. I'm delighted, in fact, very much like to continue to take questions and engage in discussion, so please do come and seek me out.
But a big thank you for the contribution and for answering the questions. Would you want to...